Hello everyone, and welcome to Accounting Insights with Rula. I'm Rula Abu Nuwar, and I will be your presenter for this course. The goal of this channel is to shed light on the world of accounting and finance, making it both practical and inspiring for everyone. Whether you are a student, engineer, or business professional, these lessons are designed to empower you to make informed decisions with confidence. Our first step together begins with the foundation of it all, the accounting equation. This seemingly simple formula holds the power to explain how businesses operate and how financial decisions are made. Let's transform complexity into clarity and make every lesson a step towards mastering the art of accounting. Every part of society, whether it's an individual, a business, or even a government, faces the challenge of managing its resources. Accounting serves as the compass guiding these crucial decisions, proving to be an essential function for effective decision making, regardless of the size of the business. And here comes the big question: what is accounting? Accounting is the art of recording financial transactions, giving businesses the insights they need to thrive and grow. It also can be defined as the process of recording, classifying, summarizing, and reporting business transactions and interpreting their effects on the business entity's affairs. Let's walk through the 5 key processes in accounting. First, recording. This is where every transaction is written down in the journal. Next, we go to classifying. Here, those transactions are sorted into the ledger based on which accounts they affect. Then comes summarizing. We use the trial balance to ensure that everything balances, ensuring our debits equal our credits. After that, it's reporting. This is where we create the financial statements that show the company's financial health. And finally, interpreting is where we analyze the data to understand what it means for the business. These steps turn numbers into meaningful insights. Let's discuss the financial position of a business. The financial position is like the snapshot of what a company owns and owes at a given time. We define it by looking at 3 main elements: assets, liabilities, and owner's equity. These 3 elements are all connected through what's called the accounting equation: assets equal liabilities plus owner's equity. Assets represent everything the company owns, like cash, equipment, and buildings. You can think of it as the company's resources. Liabilities are what the company owes to its creditors. Imagine the company has taken loans or owes money to suppliers. That's part of its liabilities. Owner's equity is the amount the company owes to its shareholders. It's the part of the business that's funded by the owners after all the debts or liabilities have been settled. These 3 components together form the financial position of the company. If you understand this equation, you are on the right track to understand how companies track their finances. The key principle behind the accounting equation is that a company's total assets must equal the sum of its liabilities and shareholders' equity. Think of the accounting equation as a balance scale. On one side are the assets representing everything the company owns. On the other side are liabilities and equity representing what the company owes to others and to its owners. To maintain balance, total assets must equal total liabilities and equity. If assets increase, either liabilities or equity must increase to match. Likewise, if assets decrease, liabilities or equity must always decrease to keep the equation in balance. Let's apply the accounting equation to a practical example to understand how it reflects a business's financial position. Assume a business has assets worth $200,000. It owes creditors $60,000 and it owes the owner $140,000. The accounting equation would be assets equal liabilities plus owner's equity, $200,000 equals $60,000 plus $140,000. If the business earns a net income of $20,000 over a certain period, the accounting equation updates as follows. $220,000 equals $60,000 plus $160,000. The accounting equation ensures that the company's assets always equal its liabilities and equity. This relationship stays balanced with every transaction reflecting the company's financial position. Now, let's move on to the second example of the accounting equation. This example involves Mr. Alan Bagan and the transactions he engaged in during the month of January. We'll go step by step through these transactions to see how they impact his company's accounting equation. Mr. Bagan invested $5,000 to open his law practice. This results in an increase in assets cash by $5,000 and a matching increase in owner's equity by $5,000. In the second transaction, Mr. Bagan bought supplies for cash of $300. This transaction results in a decrease in assets cash by $300 and an increase in assets supplies by $300. The capital of $5,000 remains unaffected. Mr. Bagan bought office equipment from Altway Furniture Company on account of $2,500. The impact of this transaction is an increase in assets office equipment by $2,500. Simultaneously, there is an increase in liabilities accounts payable by $2,500. Mr. Bagan receives the office equipment but does not pay for it with cash. Instead, he will owe the money to Altway Furniture, making him liable for this amount in the future. This creates the liability known as accounts payable. Mr. Bagan received $2,000 in fees earned during the month. The impact is an increase in assets cash by $2,000 and an increase in owner's equity revenue by $2,000. This is known as revenue or income. Mr. Bagan paid office rent for January of $500. When the word paid is mentioned, it signifies a deduction from cash as cash is being used to pay for the expense. This payment reduces capital and is referred to as a rent expense. The impact of this transaction is a decrease in assets cash by $500 and a corresponding decrease in owner's equity expense by $500. Mr. Bagan paid salary for part-time help of $200. When you see the word paid, think of it as cash leaving the business and a dip in capital. This time it's for salary expense. So the impact, a $200 decrease in assets cash and a $200 decrease in owner's equity as it's recorded as an expense. Mr. Bagan paid $1,000 to Altway Furniture Company on account. Mr. Bagan is reducing the asset cash by paying $1,000, which also decreases the liability accounts payable. As a result, he will owe $1,000 less. The impact of this transaction is a decrease in assets cash by $1,000 and a decrease in liabilities accounts payable by $1,000. After taking an inventory at the end of the month, Mr. Bagan found that he had used $200 worth of supplies. At the end of the month, the original supplies purchased have dwindled to the remaining amount. The difference, $200 from $300 to $200, represents the supplies used. This usage decreases the assets supplies by $200 and reduces capital by the same amount, recorded as supplies expense. So the impact, a $200 decrease in assets, supplies, and a $200 decrease in owner's equity, noted as an expense. Mr. Bagan withdrew $300 for personal use. When Mr. Bagan withdraws cash, it reduces both his cash position and his capital. This is not an expense, but a personal withdrawal, decreasing the amount he has invested. The impact, a $300 decrease in assets, cash, and a $300 decrease in owner's equity, categorized as a drawing. Today we covered the accounting equation with practical exercises. I hope you enjoyed this session. Until we meet again, thank you all for listening. Goodbye.